There seems to be a debate going on whether the sell-off that we've seen earlier this week can continue. It's time to trim positions. It's time to de-risk. And on the other hand, people are saying that the liquidity we've seen from central banks means that these tech stocks, equities, can rally no matter what. Where do you sit?
Yeah, so I think that the prospects for really chunky returns going forward from here are not so great. Back in May, June, we had a very steep capital markets line. So we had very high real expected returns, close to double digits, actually. Right now, we're looking at prospective expected returns in the low single digits. So it's not a very exciting environment. It's not an environment where I think you can just put money into the market and expect to get big capital returns. But what are the choices for investors? Interest rates are very low. Government bond yields are zero, effectively. So I think we're playing much more of a strategic game at this point, longer term, more modest returns, but people still have to be in risk assets. They don't have a choice. Equities, credit, et cetera, other risk assets.
Sure, and we have seen the dollar real yields as well are picking up again, Bill. It seems like it's on comments that we've seen from the Fed. They're not giving a whole lot of clarity on just how are they going to employ or deploy this inflation targeting, average inflation targeting, I should say, in practice. Does the theme of trading on an easy Fed, has that run its course now?
Look, I think that's been well telegraphed to the market for a while. I mean, it's a very substantial move. When I'm not saying it's not. It's a very big change. But I think that's pretty much worked into the market, and the expectation is lower rates for even longer, and that's pretty much priced in. So I don't think that's going to give a lot more oomph. That's not going to create an additional rally at this point. I think the thing that will get the market excited, if anything does, is an unexpectedly high bounce back in earnings. So as you've been talking about this morning, there are companies which are surprising to the upside. If we see that more broad-based across the market, an earlier recovery than expected, then that'll get the market excited. But absent that, I don't see what else could power a rally from here on.
Well, Bill, let's just dig a little bit deeper then on the earnings question. What are you seeing in terms of the numbers, in terms of how the sector breakdown is looking for towards the end of this year, early 2021, in terms of which sectors, which companies are best positioned now to be re-rated on the earnings front?
So it's, I mean, everybody's talking about this K-shaped recovery, right? So you split the sectors up and you look at what's happened to them, the trajectory, and it pretty much tallies with the expected earnings. So the sort of defensive growth companies, tech, e-commerce, they're going to be the first ones to bounce back. And then the more cyclical sectors, including financials, for example, are going to be much slower to bounce back. But what seems to be priced into the market is kind of a swoosh plus scenario, if you can call it that, where dividends earnings are back to their pre-crisis levels by the end of 21. Now that's already fairly punchy. That's already quite a punchy assumption by the market. So again, to get the market really excited, we're going to have to see something better than that across the board, and that doesn't seem likely. It doesn't seem that the cyclical names are going to be able to really participate in that recovery as quickly as necessary to get the market excited.
You have to be exposed to these risk assets, as you've said and as you've argued. What are you avoiding then, Bill?
So I think the big avoid is government bonds. They've kind of lost a lot of the features that make them attractive to investors. They're not really an offset to equities. Generally, you hold them in a balanced portfolio, because if equities go down, then government bonds will go up. Price of those bonds will go up because their yields will fall. But it's very hard to see yields falling from here, and certainly not enough to compensate for any significant fall in equity markets. And so they've lost a lot of the safety aspect. So that's a big avoid for us. I think investment grade as well globally is not looking very attractive. But closer to home, Asian investment grade, Asian high yield, as well as equities. So up towards that end of the risk spectrum, capital markets line, that's where the interesting stuff is, I think.
All right, that's where the interesting stuff is. You mentioned about tech e-commerce. That's where we're seeing perhaps the most earnings upgrades, or at least a better prospects of improvement. Do you think China tech then can maintain that leadership into the second half? And when it comes to the froth in the markets, do you think we've taken enough of that yet?
I think that it can maintain its leadership, definitely, and the rebound in the Chinese economy is really very strong, and that keeps getting reinforced. The more data that we get, the more confident we are that that's really happening. But whether it can continue to surprise to the upside and kind of draw more people in at these price levels, I think that's a very different question. That's probably not going to happen. I think a lot of the good news, if you like, is already in the price, is already discounted.